Well, hello everyone. I'm Paul Conrad, CPA from Richmond, Texas, suburb of Houston. This is the third in a series of videos that I'm putting together. Hopefully, current clients, prospective clients, friends and family, you're watching these. Hopefully you're seeing some value from this. So away we go. So this is the third video in this series. I suppose if I were to title these videos, I would call this How Does Social Security Actually Work? If you've watched some of the prior videos, uh, excuse me, you know that most of my clients are in business for themselves, and they're concerned about not only the income taxes on the profit from their business, but also Social Security taxes. And the goal is to create a situation, maybe it's forming a new entity, maybe it's other deductions, things like that. But the idea is to create a situation where we can reduce both the income tax and the Social Security tax that the business owner has to pay, excuse me. But we kind of view, and I'm guilty of this myself, we kind of view that, particularly with regards to that Social Security tax, that Social Security tax is bad. In a prior video, I coined these phrases: the bad bucket one of income and the good bucket two of income. And the difference between the two is that the income in the bad bucket one, you pay income tax and Social Security tax. The good bucket two, you pay income tax on that kind of income, but you don't pay Social Security tax. And I'm guilty of this too. Bad and good. But Social Security really is not a bad or good kind of a thing. It may be a little bit more short-term, long-term kind of a thing. Social Security is more than just a retirement plan. We tend to think of it in those terms, but Social Security has other benefits. My mother actually passed away when I was a teenager, and Social Security paid a benefit to me as I got through the rest of high school and into college, and that benefit from the Social Security system actually helped get me through college, and that would be an example of Social Security doing something good. Some people can get hurt, and there's a disability benefit with Social Security. There's someone passes away. There's a survivor's benefit for the spouse and kids and everything like that. Social Security is actually more than what most people think. We tend to think of it as a retirement type of plan, but there's other things, and you can actually integrate Social Security into your overall plan. My personal plan when I retire is to have some Social Security, but to not depend upon it for 100% of my income, but to have some other savings, some real estate investments, and just a variety of things, sort of a diversified approach, so that when I retire, I'm not dependent upon any one thing, particularly Social Security, because as a government program, it's subject to change. It's changed a lot over the years, and it could continue to change. But let's talk about that retirement benefit. Most people, it's kind of a black box. How does this happen, I guess? So let me give you some of the basics. Now, I am not a Social Security expert knowing everything, but I know enough to make some good decisions for myself, and I can give you some information that will hopefully allow you to make some good decisions for yourself too. And as a business owner, one of your advantages is how much to use Social Security or not. You can kind of dip your toe in and step back out, and within certain limits. Don't get me wrong, but our effort, our final goal is we do want to use Social Security, but we want to get the most benefit and put the least dollars to work in that system as we can, and free up dollars for other things like 401k plans and retirement plans and real estate or stock markets or whatever you want to do with your money, actually. But we do want to integrate Social Security into this plan. Okay, it's not all bad. So how is Social Security? How is the retirement benefit even calculated in the first place? Here's what happens. In a prior video, I talked about bad bucket one, good bucket two. what Social Security does is it measures the amount of income in that bad bucket one. When you work and you have Social Security taxes withheld from your check, that earnings counts in the calculation of the Social Security benefit. If you were in a situation, let's say you didn't work, and you had enough money in the stock market and you earn dividends or capital gains, and you pay income tax on those kinds of income, but you don't pay Social Security tax, well, that income doesn't count in this calculation that we're about to do. So when I talk about your Social Security earnings, I'm not talking about all the income that you make. I'm talking about the income that has been taxed for Social Security purposes. Most of us, you kind of start working maybe late teens. Let's say you start 17, 18 or something, and you work maybe into your 60s or something. There might be 40 years that you've paid. You and your employer, if you're a W-2 employee kind of a person, that you've paid into Social Security, and Social Security keeps track of this over however many years you've been working. Essentially, at the end of your career, or when you're going to start collecting benefits, the Social Security Administration, they calculate a 35-year monthly earnings. So let's say you worked 43 years, and you had some high years and some low years, and then some really high years, and then maybe a year where you didn't work at all, you were unemployed or something. But you worked 40 out of 43 years or something, I don't know. So you have 40 years to pick from. They pick the top 35 of those years, and they come up with an average, and so they'd add up the top 35 years, figure out what your annual Social Security earnings is, and then they divide that by 12, because there's 12 months in a year, and they would arrive at what is the average monthly earnings of the top 35 years that you worked. Now they apply some cost of living increases, so it's not quite as simple as just adding up 35 numbers and dividing by 35 and dividing by 12. It's not quite that easy, but you get the idea behind it. That's kind of what happens. Now let's say you didn't work 35 years, you only worked 25 years, and maybe you stayed home and raised kids. Maybe, a lot of times it's the wife, but in today's society it's not always. I know husbands who stay home, but you may have a person who doesn't have 35 years in for whatever reason. The Social Security Administration, they still want a 35-year average. So if you have, let's say you only have 25 years of earnings, what they'll do is they'll plug in 10 more years at $0 to get a 35-year average. So it kind of hurts to not have 35. It doesn't hurt as much as you think, and I'm going to show that to you here in a minute, but that's how they get the 35. If you don't have 35, they plug in zeros, and away they go with the same formula. By the way, if you don't have 10 years, 10 years is the minimum to get a retirement benefit. There are other benefits that don't require 10 years. There are some benefits that what happened a long time ago doesn't matter, but maybe what happened the last 5 years is really important. So there's different numbers of years for different kinds of benefits that come out of the Social Security Administration. But with regards to the retirement benefit, you have to have paid into the system for 10 years to get any kind of a benefit at all. And I'll have clients who'll come in, and a lot of times husband and wife are sitting across the table from me, and we're talking about saving Social Security, and almost without fail, when I've talked about saving Social Security, one of them says, am I giving up my Social Security benefit? And that's where I talk about 35 years. If you don't have 35, but you got to have at least 10. And I'll look at them and I'll say, do both of you have 10? And one of them usually goes, no problem. I've been working since I was 16. I've got 30 years in. And I look at the other one and I can see they're kind of thinking, I'm not sure that I have 10 years or not. In that situation, a lot of times what I'll suggest is that when they're self-employed, the one that has the business hires the other one to get them to 10 years. I don't want to be sexist in this comment, but let's say the husband runs the business and the wife has been taking care of the kids, and she worked for 6 years, and then the kids started coming along and they were well enough off that she took the time off. So I'll look at him and I'll say, you should hire her for 4 years and pay her the kind of income, like a W-2, that triggers that Social Security tax. You're going to pay a little bit more now, but we want to bridge that missing 4 years and get you from 6 to 10. That'll give you a lot of flexibility. So the first thing you want to do if you're listening to this video is, do I even have 10 years? And the way you find that out is Social Security can tell you. You can get an account online and download private, secure information, and it's very helpful. I'm going to talk about that in just a little bit. But one of the things that you do want to do is you want to get to at least 10 years, because if you don't, it's just money that's gone down a hole. You don't get anything back for that. Let's say that, so you got 2 people, and we're going to call them, the really hard-working guy is named Dave, and the not so hard-working guy is Paul, myself. Dave is my brother, by the way. So you go through this 35-year, highest 35 years, figure out a monthly average, and let's say that Dave's monthly average earnings is $6,000, and that mine was $3,000 per month. This is on an average over basically a career. Your first thought is, well, Dave's retirement benefit should be twice as much as Paul's. I mean, after all, Dave and his employer paid twice as much into the Social Security system as Paul did. Dave was real hard working, nose to the grindstone, burn the late night oil, candle at both ends, whatever phrase you want to use. Paul, not so much. He went surfing and or played tennis and slept in some of the days and didn't really work as hard as he could have. Okay, so we end up with this $6,000 per month average for Dave and $3,000 for Paul. Dave should be twice as much, right? Wrong. That's not how it works. What the Social Security system, the formula for what they apply to this, here's how this works, and you're going to see why Dave's benefit when he retires is not twice as much as Paul's would be. They take this number, once they've determined this 35-year average, they take this number and they slice it up into ranges or brackets. I think they call them bend points at the Social Security system. Don't worry about the name. It'll make sense when I chart this out for you. They carve out essentially the first $900 of this. Now I'm rounding a little bit. These numbers, they're to the dollar, to the penny. They can change year by year. They're indexed for inflation, things like that. So these are not exact numbers, but these are close enough that you'll get the point, okay? Roughly, the first $900, they multiply that by 90%. And that's the first part of the benefit that both Dave and Paul are going to calculate, going to receive. So we're both, at these numbers, we're both over the $900. So 90% of $900. So the first pass is Dave gets $810 and Paul gets $810. Makes sense. We both got to the 900. After the 900, there's another level that comes into play, a bracket or a bend point or whatever you want to call it. And these are approximate numbers, but from about $900 to about $4,500, they take whatever dollars are in this bracket and they multiply it by 32%. Pretty big drop from that 90% up above. Dave has, this is a $3,600 range from $900 to $4,500, that's $3,600. Dave has enough dollars to fill up this level, this bracket, to reach that bend point. So he gets 32% of the whole $3,600, and I'm going to look at my cheat sheet over here, and that is going to be $1,152 added on to Dave's benefit. Good for Dave. I only had 3,000, so I didn't reach this bend point right here. I've already used 900 here, so I've got $2,100 in this bracket, this bend point, this whatever you want to call it. $2,100 times 32% is $672. So we're already starting to see a difference in Dave's benefit and Paul's benefit because Dave's number is higher. You'd expect he would get a higher benefit. The question is how much more is he going to get? There's a third range, get my fingers right, and that is anything that's over $4,500. Well, I only had $3,000, and we used up the whole $3,000 in these first two brackets, so I don't have anything in this one right here. So let's put a 0 for me. Of that $6,000, Dave used 900 of it here. He used another 3,600 of it here to get to the 45. If he has $6,000 as his 35-year monthly average, he's got $1,500 still to go in this bracket right here. So $1,500 in this third calculation for him at 15%. So it's dropped again. 15%, $1,500 he has in this bracket, $225. That's the end of that calculation for us. If you add this all up, you for Paul, you would get $1,482 a month, give or take. Do your own math. It'll be pretty close. And for Dave, assuming I did my math right before I even started the video, it's $2,187 a month for Dave. Well, wait a minute. Dave and his employer paid in twice, exactly twice, what Paul's employer paid in. But what you'll notice is that Dave's benefit is not twice as much as Paul's. What happened? Why is that? Well, the answer is right here. You get the biggest bang for your buck for the first dollars you put in. For the medium dollars, it drops. It's only about a third of what the bracket was, the percentage in the bracket above that. And then this one drops even more. And what happens is, the more you pile into the Social Security system, you don't get a corresponding proportional increase in the size of these dollars here. So you end up with this lopsided answer. Dave's benefit is about 50% more than Paul's benefit, but Dave didn't pay 50% more. He paid 100% more in tax to get there. That's just kind of the way it works. There really isn't much of that's just kind of the formula, okay? To kind of cap this all off, this can only go so high. This monthly benefit, I have to think, it's been a little while since I've looked at it, but I kind of want to say it's in about that $3,000 range. So this could be $106,000 per month, and your benefit caps out at $3,000. And even at 15%, there's only so much good you can do, because if it caps out, it caps out. It's just the way it goes. The reason I go through this is to show people, first of all, to give them an idea how this works. Now, this isn't chump change. If I was walking down the street and there was $1,500 lying on the ground every month, you're darn right I'd bend over and pick it up. But I don't know if I would intentionally keep feeding a lot more dollars into the Social Security system to try and get that number to kind of look a little bit more like that. I got better uses for my money. What I tend to see happen is, so someone who's been in the Social Security system for a while, let's say they're 45, maybe 50 years old, they've been an employee a long time, Now they're going out on their own, kind of a second career kind of a thing. And we run this kind of analysis. Now they may not have 35 years yet. Maybe they only have 25. But the reality is even if you take all of those 25 years and you plug in 10 more zeros and you calculate this 35-year average, the 25 years that they did pay money into the Social Security system is strong enough that it kind of covers for the missing 10 years, the 10 years at zero. It kind of compensates for that, and they get a pretty good benefit even though they don't even have 35 years. And that kind of client is a prime client for me and lots of other CPAs who do this and understand this. I'm not the only one. But the goal would be is if you have a good, strong history of Social Security and you're already kind of looking like this, should you feed more money into the Social Security system for that kind of return? May not make a lot of sense. If you're an employee, you don't have a choice. Your employer is going to deduct Social Security. They're going to match it for you. That's a good thing. And send it off. And you don't have a choice to opt out of this Social Security system. You don't have a choice. But if you are running your own business and you know a good lawyer or a good CPA, something like that, and we set up a business where you pay yourself in such a way that you can avoid some of those Social Security taxes, and you can end up with what could be a pretty strong Social Security benefit without feeding a whole lot more money into the system. But you take that money and you build another little pot of money. Hopefully becomes a big pot of money. I've had people, I've done this example. We've done this analysis for very specific clients, and I say, here's my example. This is a good one. Used to have this client. He was 66, 65 years old, and he was making, $100,000 a year profit, and he was paying 15% into that Social Security system. He was paying the employee and the employer portion together. It ended up being about 15 grand into that Social Security system. And I said, what if we were to set up a company and we reduce the amount of Social Security taxes that you paid right now? And his first comment was, would I be jeopardizing my Social Security? I said, okay, at 65, I'm assuming you've got 10 years in. Yeah. Assuming you've been paying Social Security what feels like your whole life. Yeah. And I said, so let's figure out what would your Social Security benefit be if you didn't pay any more into the system. There's a way to do that if you know how to use the Social Security's website. It kind of has a look ahead feature. You can put in what your historical numbers are, but in the box it says what's your current and future earnings. You can put in any number you want to there. And we put in a much lower number than what he's earning right now. Forming an entity would allow him to sort of structure how he pays himself, and we put in a much lower number, much, much, much lower. It wasn't 100 grand, it was like 10 grand or something like that. And we hit the calculate button. This is as clear as day. We were in his office. I'm actually sitting at his computer. He's leaning over my shoulder looking at the computer, and I go, are you ready? Click, and it says your future benefit, and it was $16 a month less than what it would have been if he had continued paying making that same $100,000 and paying that same $15,000 into the system. And you could just see this guy the wheels were turning and the shock, and he said, wait a minute, let's make sure I'm getting this right. Are you telling me that if I paid Social Security tax on 10 grand and not 100 grand, and I saved all the rest of this money, I'm waiting for the end of the story, I would only have to give up $16 a month? And I said, yes, because of the strength. You're 65 years old. You've been paying into the system for a long time, already 42 years, 45 years, whatever it is. They said, you don't need any more money in the Social Security system. It said it would be to your benefit to reduce your Social Security burden. As a business owner, you can do that, and take that 15 grand and go put it in a solo 401k plan or something like that. Said you'd give up 16 grand, but in 2 or 3 years you'd have 30 or 45 grand in this pile of money. You could take more money out of this pot of money to make up for the $16 that you gave up per month. By a lot. I mean, by a lot. and he was so close to retirement. He said, God, that's great. I wish I had known this, but I don't want to fool around with forming my own business. I'm going to retire pretty soon. So he never did. He never formed that business entity, and he continued to pay the full amount of Social Security tax as what he had been paying, and he didn't leverage off this idea. In my own case, I graduated from college. I use myself as an example. I graduated from college, went to work for a CPA firm for several years, went into what I call private industry. I was the chief financial officer and vice president of a corporation out of Southern California, and made a pretty good salary over that time period, and had built up a pretty good history of my Social Security earnings, and the job separated me away. And so I decided I was going to go back into business. I was going to go into business for myself. And I did this Social Security calculation. And in my case, what I determined was that if I never put another dollar into the Social Security system, I'd have a certain benefit. Let me rephrase that. I didn't say that right. If I continued to pay into the Social Security system, in line with what I had been earning already, I'd have a certain benefit. That's the starting point. If I stayed in the system, I used the Social Security website. I figured out what would my benefit be if I didn't put any fresh money into that system. And the difference between the two for me was about $240 a month. Not $3 grand a year. 240, 12 months, about $3 grand. But by not putting money into the Social Security system, I was going to save about $15,000 a year. As my income has gone up, my Social Security tax, it would have gone up too. Somewhere between $15,000 and $20,000 that I'm not putting in Social Security, but I'm building this pot over here. And my plan is when I retire, I'll have 2 pots. I'll have my Social Security pot, which isn't growing, but I'll have this other pot that is growing by the money I'm not putting over here, I'm putting it over here. And if you're disciplined, you'll have more money in 2 pots than you will if you just put all your money in this other pot, the Social Security pot, and you had to live with this returns, this 32 and this 15% coming back. So is Social Security, let me wrap it up. Is Social Security bad? It is not bad. It's actually I think one of the more successful government programs we had. I think it's 75 years or something like that, maybe longer than that. Lots of people, lots of benefits, lots of situations. Me myself, when I was in high school and college, I got a benefit. Can't complain about that. So there are good things that come out of Social Security. The point is, you can get those good things by paying in a little less or a lot less than if you kept putting all of your earnings into that system and paid the tax that you'd have to pay on all of that earnings. So you can manage that. That's one of the advantages of being self-employed, is you can kind of manage this how much you put into that Social Security system. My last comment, I have clients where we go through forming an entity, we walk through this, they get it. We form an entity, we're saving them Social Security taxes, and they drive up next year in a new car. And they drive up and they tell me about the really nice vacation, the nicest vacation they've ever took. And what I've concluded, and it kind of makes me a little sad, is they are consuming the savings. They're not saving the savings. They're consuming the savings. And at the point when they retire, they would have been better off staying in the system rather than trying to manage it to a little less number, because they didn't save the money. If you don't save the money, you are going to be worse off. Hear me clearly. If you don't save the savings, you're going to be worse off. the best clients I have, the ones I love dealing with, is the ones who have the savings, and then they come back to me and they say, what do I do with these savings? And we can actually leverage those savings for more tax savings. Awesome. I love that. I love that client. I hope you're that client at some point, for me or for some other CPA, actually. There's a lot of strategies about how you get your money out of Social Security. Do you claim on your record, or do you claim on someone else's record? Do you wait? Do you take it as early? There's early retirement, there's the normal retirement, and there's a delayed. You can, at the moment, get Social Security as early as about 62. Full retirement age is about 67, but you can delay. Now, what's the reason you might delay is you get less money if you take it at 62. You get what they call the full amount at 67. You get an even higher amount at if you wait like 4 years. So that and that's my plan. Actually, I'm going to try to wait 4 more years after what's called the full retirement age. Why am I doing that? Every year you wait, the benefit goes up 8%. If you wait 4 years, that's the most you can wait. If you wait 4 years, your benefit is now 32% higher than the full. And the full is, I think, 25% higher than the early. So it's a pretty big difference between the early and the delayed. Now you gotta get there. You gotta have enough money to get there. So that's another issue. But in my case, my wife, my wonderful wife Kara, is 13 years younger than I am. And my understanding of the Social Security system is that when I take a retirement benefit, a delayed one, a higher amount, and at the day that I pass, she will either get her Social Security or mine. She gets that choice. And mine, hopefully, is this higher amount. And my goal is to get this higher amount, not only for my retirement years, but for my younger wife. There are programs and there are consultants out there who will advise you what is the best way to get money out of Social Security, to get the most money. Because there's so many variables that you really need some help on this one. This might be one where it might be worth paying a couple $100 to a consultant, or $50 for a program that lets you do a bunch of what ifs kind of things. And if you're married, your spouse, and you combine these and ages and histories and everything like that, and you can get some pretty detailed calculations with regards to when I retire, whose record am I retiring on. There used to be a strategy called file and suspend. That's not in place anymore, but there's some variations of that. And it can get pretty complicated, actually. Okay, so I've kind of veered off topic, but just kind of know that Social Security, it's not all bad. We just don't want to overfund it. We want as much benefits and put as little dollars into the system as we can. Calculate your own, or better yet, sign on to the Social Security website, and you can download this 4-page letter. They used to mail it to you, but they're cutting postage costs, so they don't mail it to you anymore until I think you're 60 years old, but you can download it anytime you want to. Page 3 of this 4-page letter tells you what your history is, what the earnings that you've paid Social Security on, not your total income, your Social Security income. Page 2 at the top half tells you this is what your benefits are going to be, with certain assumptions behind that. And you can sort of, the first step of anything is to know, where am I at the moment? And getting that 4-page letter record from Social Security, that's an excellent start. My clients, they sometimes bring that in. We talk about that. We review this. We make sure that we're putting some money into Social Security, but not all of it, kind of a thing. And trying to maximize the benefit all the way around. Okay, I hope you've learned a lot. Hope you've enjoyed the video. I'm finding out I'm really enjoying making these videos. I hope you're enjoying listening to them as much as I am enjoy making them. PaulConradCPA.com, that's my website. Feel free to contact me. Set up a face-to-face. I give away a lot of free time. First-time clients. Just so they can get to know me, I can get to know them. We can see if we'll be a match. We're not always a match. and maybe I can help them out. In any case, I hope you have a tax problem. Again, that's my way of wishing you well, that you're doing well, and taxes is something you got to at least think about, including this Social Security tax. Take care, everyone, and I will see you on the next video.